In today's video, we're going to be diving into the Prudential pension in the UK. If you're inside the scheme, if you're considering to transfer out, and a bit of an insight from our side of some existing clients who our senior advisor, Jonathan Laws, has recently done some analysis for. Jonathan, good morning to you in Richmond. How are you?
I'm very good. Bit of a sweatbox London at the moment as well, but can't be complaining.
And also, Jonathan, a Dicky Bird told me it's your birthday tomorrow.
It is indeed. It's my birthday tomorrow, correct.
All right, on to pension matters. So, John, if you could start us off with Prudential pension, what you think is important as a summary overview for people, and then we'll get into a little bit more detail with some of your specific cases.
Yeah, so from a kind of personal Cameron James myself perspective, we've seen quite a few inquiries recently from those with Prudential pensions. Now, Prudential is obviously a very big, very well-known investment provider, pension provider in the UK. So there are obviously thousands, tens of thousands, heck, there might even be hundreds of thousands if I go and look at the numbers, who've got Prudential pensions. And in many ways, they're sort of a default option or one of the first kind of personal pension style arrangements that came out, back in the day. I mean, being in your 30s back in the day might mean it's slightly different to everyone else. So we've come across them, and then there are certain issues for those with non-UK beneficiaries, those who moved abroad with Prudential, that has been sort of the trigger for those inquiries with Cameron James, and especially recently, and for non-UK residents in particular.
So from a UK perspective then, John, so what applies to everyone, UK residents and non-UK residents, what would you say are some of the key disadvantages when you've done the nitty-gritty analysis, you've compared Prudential versus, say, doing a defined contribution pension transfer, such to an SIPP? What's been the key differences that you've seen in your analysis, and what comes up every time, typically with the Prudential pensions you analyse?
Yeah, so again, these sorts of packaged life provider old style things, that the main thing is obviously they've got quite a high, in my opinion, what I would consider high sort of bundled total fee. The base sort of AMC, as they call it, the annual management charge, which is the cost for all the underlying investments in that fund you might own, starts at 1%. Then there might be additional kind of transactional charges on the end, or additional levels, because if you've got the more complicated, you've got a certain menu of options. Some of them, whether it's a property fund or something more esoteric than your typical kind of global equity or US equity or UK equity fund, one of the ones we last reviewed had an extra 0.28% on it. So, that was 1.28% a year they were paying in annual management charges just for having a sort of bundled pension, no investment advice, incredibly limited options. They've only got a small menu of options there, and obviously, the ability to go out and create your own low-cost, globally diversified portfolio like we use at Cameron James is essentially nigh on impossible. So that's sort of the cost side of things that applies to absolutely everyone, whether in the UK, not in the UK, or whatever. And then the other side of the thing is, again, with high charges, with a lot of, quote unquote, active management, the performance, is often really poor as well. I've got an example here. I use what we did at the end of last year, and we looked at the 5-year returns, put it into our FE analytics, looked at what the client actually did, and over the past 5 years, and I promise you we can vouch for this, the disclaimers at the bottom, the gross return, or net return, because they show you the net, was 3.1% for this chap's portfolio. 3.1% over 5 years.
Over a 5-year period.
Yeah. And then for reference, this client also had, we were doing a consolidation. This is for someone in the US. And again, as we'll go into in a little bit, fees and costs and performance are kind of secondary in many cases for a lot of people who move abroad. There are other issues there. He had an Aviva pension. Now, again, often can be similar issues, but just in comparison, this Aviva pension did nearly 30% over that time frame. Now, how much did the Cameron James advised portfolio we advised to? Again, past performance, no guarantee of future returns and stuff, but we were converting them into US dollars, putting them advising into our Cameron James USD portfolio, And the gross return of that over 5 years was nearly 68%. And even net of all fees, including ongoing advice, full fat financial planning, all the help with all those other assets and retirement goals, and making sure money gets spent, and he enjoys this great retirement, would have netted about 58% over that 5-year period. So that's 58% versus 3%. That's quite literally life changing.
Wow, lots to unpack there. The first thing I'd like to unpack before we get into the performance, which obviously we're talking about vast sums of difference there. If somebody has £100,000 and it's grown by net of circa 3 or 4% over 5 years, it's then worth £104,000. If somebody's had circa 55% net growth or whatever it is, it's £150,000 over 5 years. So I want to get into that in a minute. But first of all, John, if you could just confirm for our watchers, our listeners, our viewers, exactly when someone says, okay, the Prudential fund is, say, 1% AMC, or one you said was slightly more, 1.26, people might say, but hang on, that's roughly what a financial advisor charges. So sounds about the same. What's the problem? Could you, obviously, I know the answer to this is a trick question, but could you go into that in more detail, John, and outline what is the actual difference between paying 1 or 1.26%, whatever it is, for the underlying fund fee, as opposed to saying paying 1% for a financial advisor, which is the common cost in the UK or US, wherever?
Yeah, absolutely. Now, obviously, costs are costs. What really matters is the value. What am I actually getting for that cost that's being charged to me? Now, if I've got 1% charge or whatever it may be, and that's being used to go to an active fund manager who's playing around with my investments, instead of taking what all the evidence says is the best way to invest for most people in the UK pension, which is low cost, globally diversified, the keep it simple, stupid approach, which is, a key foundation of how we invest in Cameron James and how we advise our clients' money. You're spending all that money on telling someone to buy an investment team. They've got to do all this research. And the chances are you're spending money to lose money, or spending money to have less money, as all the kind of research on active management versus passive management shows. So that is a key thing for us. You see in the charges, what do you actually get for it? Now, of course, what else does a financial advisor do? Well, we're going to make sure that you're doing proper comprehensive cash flow modeling. We're going to make sure we're taking into account all your other assets you own, or your liabilities you might own if you've got a mortgage. Income streams coming in. If you've moved abroad, you've probably got 2 or 3 different jurisdictions you're dealing with, assets across the border, tax issues, all this kind of stuff. So all this really high level value add stuff you're getting for that 1%. Whereas if you're just looking at your existing pension arrangement, you're actually paying money for what is evidence-based is actually going to reduce the value you're getting. So, it really is an apples to pears comparison.
Yeah, because if you look, for example, off the top of my head, I think the USD balance portfolio is around 12 or 14 basis points. That's the cost of our underlying fund and portfolio. The cost with Prudential in this example you give them is 1 or 1.26%. So it's a massive difference. And here at Cameron James, our cost for an ongoing advice fee is 1% per year, which includes all the financial planning we do, the cash flow modeling, etc., plus the 14 or 12 basis points for the underlying portfolio. It's actually almost the entire cost of just the Prudential fund alone. But with Prudential, clients are not getting ongoing conversations, financial planning, cash flow modeling, etc. So yeah, massive difference in terms of the value that's been provided. So to come back to performance, John, what did your clients say? I think you said it was the back end of last year. What did your clients say when you produced the report for them? And again, the performance is done by FE Analytics. We can't change the results here at Cameron James. What did your clients say to that? And were they already aware of the lack of performance of their Prudential and it was something they've been meaning to get round to, or were they a bit shocked by it?
Yeah, there was obviously, I think the overwhelming thing was, the sort of, wow, I didn't quite realize, how poor the growth was. I just sort of saw it going up, or I hadn't really paid attention to it. And, fortunately for the person I've got in my head, this was their much smaller pot. So the kind of issues of not taking advantage or looking at things earlier, weren't as bad. But, I've got another client who had a really sizable pot. And I know, for example, you just referenced there, but actually, because they were seriously substantial pots, because they have other money we're managing, their ongoing fees in total were actually lower than what they were currently paying. So we not only, we've got full fat financial planning, SIPP designed for a non-UK resident, low cost portfolio, £5.95 a trade, or whatever it is, I believe, for the SIPP platform we advised, is actually now paying less than what he was to a fund manager and incorporated bundled fee with Prudential, getting that much better historical growth. We've done some currency stuff because you can do that, in the SIPPs we use for non-UK residents, and he's getting all that value add, and he's actually paying less money.
Okay, understood. And obviously, viewers, if you're listening and viewing this thinking, okay, sounds interesting, always remember with Prudential, it's a defined contribution pension scheme in the UK. It's not the more complex older brother called a defined benefit scheme. So any client who gets in touch with us, we go through and do a full analysis of your Prudential versus working with, for example, a SIPP is the most common situation for people non-UK or UK residents. We outline the product, the trustee, the performance, the 5-year return, the risk, everything, the geographical split in comparison to your Prudential pension in a very, we call it in black and white or blue and gold here at Cameron James, in an advice report for you to see crystal clear before you make any form of decision or educated understanding of whether you want to work with us or not. So if you want to have a conversation with myself or Jonathan or one of our advisors here at Cameron James about your Prudential pension, you can go to the calendar section below and find a date and a time which is suitable for you. So Jonathan, when your client sort of realised the difference in performance of the Prudential pension and the recommendation that you provided them, did they then move quite quickly ahead with the advice, or do they have other questions? What are the typical questions clients have when they're, say, moving away from something such as Prudential, which, in fairness, I mean, Prudential have been around for donkey's years, very, very big brand name and reputation. How do clients feel, when they're potentially making decisions like this?
Yeah, so the big thing as well, and probably just slightly to kind of wedge in here, is the big reason they got in touch in the first place is the fundamental issue with Prudential is that they do not provide survivors' pensions for non-UK beneficiaries. So if you move abroad and your wife has moved with you, or you've got kids who've left and they've gone to work in Australia and whatnot, if you pass away, as far as we know, and as what Prudential confirmed, they will not be able to effectively roll on or roll over or provide a new pension for your beneficiaries. We don't know for a fact if they'll allow you to transfer to a new provider. They probably will, but there is a slim chance they won't. But that was actually the key reason these two got in touch with us was, hey, I die tomorrow. I live in a country which is going to tax all of this, and my wife's going to inherit this and pay half of it to in this case, these were US clients, to the IRS or whatever it may be, or whatever the ultimate percentage may be. So that was actually the real initiative they came in touch. The performance boosting, the cost savings in the case of one client, and then obviously all the additional value add were great. Was kind of cherries on the top. But actually, fundamentally, they were saying, right, I'm in a pension scheme that is not geared up, and objectively, from their point of view, and certainly from our point of view, knowing our experience, not suitable for a non-UK resident. So all this other stuff was kind of like, hey, okay, let's get going then. Why the heck would I stick around? I'm in a pension. If I die tomorrow, I've got big issues. My performance is not great. Again, there's loads of different funds in there. There will all be different rates of return, but the ones we reviewed, performance was poor, high charges for what you get. And I can go and get a much simpler, much better value add arrangement with a really good cross-border qualified and regulated financial advisor, and have all those other benefits. Like, why wouldn't I? And they effectively bit our hand off once we finally got all the information and put the reports in front of them.
Yeah, understood. And obviously from our perspective, we haven't analysed Jonathan said earlier, it could be tens, hundreds, maybe thousands, tens of thousands, hundreds of thousands of people with Prudential pensions in the UK. Of the analysis that we've done, every time we've analysed a client who has a Prudential pension, we have found the performance to be absolutely lacking in comparison to global markets, even if you compare it against global indices. When we say passively investing, what Jonathan's referring to there is effectively investing as per the global split of the current economy. So with the US being the largest global stock market, being the largest holding in someone's portfolio. Typically speaking, what we find with a lot of UK pensions is they have an overweight bias to certain markets. So for example, in the UK, you'll sometimes come across clients with 30, 40, 50% exposure to the UK stock market, even though the UK only makes up 2.5% of the global economy. Anybody who's taken a 25% overplay on the UK is very confident of the UK in an economy and what they think it might be able to achieve over the course of the next 5 to 10 years. And that's the whole ethos here at Cameron James, is that we're not trying to be smart. We're not trying to overplay certain markets, buy and hold the markets in the world at a low cost. So out of all the analysis we've done with Prudential pensions so far, we've always found them to be lacking from a performance perspective. Jonathan, I don't know if you remember, I'm putting you on the spot here, when you reviewed the analysis, do you recall roughly what sort of geographical split? And again, I appreciate each client might have something different at Prudential, but just an example of these real clients, do you remember the geographical split towards like the UK or US, etc.?
Yeah, again, because it's a personal pension, a lot of the times it was clients just picking things. Let's be honest, a lot of the people who have got a Prudential pension probably just clicked a random menu of funds 15, 20 years ago and have just left it. And back then, it wasn't as easy to invest globally. The US markets had just had .com crash. You just had GFC, all this incredible S&P 500 growth the past 15 years or so wasn't on people's minds. So invariably, they probably ticked a lot of the stuff they knew: UK equity, gilts, bonds, managed, all these other kind of buzzwordy funds you see in there. But yes, based on our analysis, most clients, are taking a much higher level of UK exposure, way above the relative level. And obviously that's been detrimental because the UK, whilst it's obviously not too far away from recent highs now, has been relatively floundering, especially compared to the rest of the world and obviously the US in particular. So it's been a big drag on returns. And again, here's the kind of value add of coming to an advisor, and because a lot of people go, I'm going to wait a bit, I'll make the decision next year. And it doesn't take long in an unsuitable portfolio. Again, markets can go up and down and all the rest of it. But if we get a good year in the stock market and you've got all your money in expensive funds in countries that aren't doing so well, that's several years of fees you've just wiped off or left on the table because you oohed and ahed from doing what is the good objective thing to do, which is to change things.
Yeah, understood. So John, what would be your final thoughts or comments to anybody with a Prudential pension out there who's considering to get advice in the UK, outside of the UK? What would be your thoughts to them and how they should proceed and do their homework, etc.?
Yeah, so as I said, if you're in one of these Prudential personal pension plans, you've got these bundled charges. The first thing, you might be doing just to make sure, I'm not full of it, is to go to your scheme and ask for, the proper breakdown of what charges you're paying. But of course, if you're a non-UK resident, absolutely, the first thing you should be doing is getting in touch with a cross-border financial advisor, because you're probably in a pension scheme that's got issues that you didn't realize. You're probably paying fees that you didn't realize were so high, and your performance is probably a lot worse than you thought, or potentially a lot worse than you thought it was. And, you need to get it looked at. So that'd be the first point in the call I'd be looking at, because obviously we want to make sure, you're in the right situation, your family's looked after if anything happens to you. And if you're in Prudential and you've got kids abroad or you're abroad, that's probably not going to be the place to be.
Understood. All right, well, thank you very much for your time this morning, John. And as mentioned, if anyone has any comments below, let us know about your Prudential plan, the good, the bad, the ugly. And as always, take care of the UK pension assets.